Hi, I'm James Robinson, and this is my video series, which I call my Stock Pick of the Week. This is my second of 3 videos in which I'll try and continue to answer questions and comments that people have made on my page. This time I'm talking about one specific comment and question. It's about the appropriate amount of time to buy and hold a stock and whether you should do it long term, hold a stock forever. I don't think it's a very simple question, and I'm not going to give you a very simple answer, but I'm going to give you hopefully some things to think about, give you some nuance to your thinking, so you can help figure out what makes the most sense for you. But I want to stress that I don't think anything's right, I don't think anything's wrong. I think you need to think about what makes sense for you, but hopefully this will give you some framework. So this comment said, I also personally try to invest for the long term. I've sold one stock over the last year and bought something better. So effectively, he keeps most things for a long time. My concern with your strategy is the short-term mindset. Taxation that eats away profits and therefore uncertainty that the strategy will beat the S&P 500 in the long run. What are your thoughts? Would you share your real estate returns after taxes, commissions, if any? So there's a lot to unpack there. I'm going to answer that in 3 or 4 different ways. The easiest part to talk about is my taxes and commissions. So I don't pay commissions. Fortunately, the account that I use doesn't charge me any commissions, so I'm able to bounce in and out of stocks without having any cost there. Regarding taxes, using round numbers, I made a profit of about $30,000 last year. And if we break that down, you'll see that about $2,500 of that was dividends. I was going to pay taxes on that anyways. About $7,500 of that is for stocks that I haven't yet sold, so they're unrealized gains. So in America, there's no taxes there. So that leaves about $20,000. And my account is about 50% in an IRA, which is not taxed, or at least tax deferred until I retire. And the other 50% is in current companies. A regular account, which would be taxed. So of my $30,000 in profit, I've got taxes on about $10,000. So the delta between a short-term capital gain and a long-term capital gain might be 15%. So I'm saving $1,500 out of $30,000 worth of profit by not waiting and making it a long-term return. I also want to say that I didn't necessarily start the year looking to sell all those stocks as quickly as I did. This was a great year and a lot of stocks really bumped up pretty quickly, which put me in a position of saying, well, I've sort of reached my goal for this stock. Should I sell it or should I keep holding it? And in some cases, in most cases actually, I decided to sell it because I had other things I wanted to invest in. But there's more to this situation, this issue, than just that. Another concern that I have is, so first of all, let me set the table. I'm not trying to help you run a portfolio of stocks. I'm saying to you individually, this is a great company. I think you should think about this company. I think you should invest in it. And I'm saying at this price, I think it's a good buy. I also tell you when I sell. That doesn't mean you should sell. You should decide for yourself and do your own homework to decide when you want to sell. I've got sort of a moral quandary because I don't feel comfortable telling people to buy a stock that I don't own. And I also don't want to own too many stocks because then your results fall victim to the regression to the mean. So I can only buy so many stocks. I can only hold so many stocks at the same time, and I'm finding great stocks to buy. And so I'm willing to forego a little bit of potential profit, or maybe I'm willing to be obligated to pay a little bit more taxes because when I find a great stock, I want to tell you guys about it, and that means I have to buy it, and that means sometimes I have to sell something else to buy the first one. But again, I want you to understand, I'm not managing your portfolio, and I'm not telling you what to do. I'm telling you what I do, and that might make sense for you. Another thing to keep in mind is that as I'm learning, as I've created this page, a huge percentage of my subscribers are not in America. And so they're going to have a totally different set of tax consequences and issues and concerns. I don't know what the tax situation is in Finland, and I don't know what it is in the United Arab Emirates, but I have a follower in both places, and I suspect they're not the same, and I suspect they're not the same as they are in America. So what I'm going to do is just try and focus on, this is a good stock, and here's why, and I bought it. You know I bought it if I tell you I think it's a good stock. And out of a sense of duty, I'm going to tell you, hey guys, I've unloaded it. Do what you want. Keep it, don't keep it. Do some more research. But I no longer own it, and I'm out. You do what you want to do. I hope that sort of settles it. But another thing I want to talk about is, look, I understand that Warren Buffett's strategy is the perfect time to hold a company is forever. And everything I do is based on Warren Buffett, and I've followed Warren Buffett. It's possible I've read every word he's ever written. But he is brilliant, and he's really smart, and he's really experienced, but he's not infallible. And the idea that you would buy something and never sell is not actually what he does. He has some, if you go back and look at the stocks that he owned 10 years ago or 5 years ago or 3 years ago and compare them to the current portfolio, you'll see there's been some turnover. I'm gonna do an analysis on Coca-Cola in a second and show you why the idea of buying and holding for an infinite time period, in the case of Coca-Cola, turns out to have been a really good idea until it was a really bad idea. And so we're gonna talk about that analysis here in a second. But again, what you have to remember is that you're doing what makes sense for you, and your situation is different and unique. So while Warren Buffett does what he does, he's doing it because he has his set of circumstances. Consider that Warren currently has $128 billion in cash at Berkshire Hathaway. Consider that if Warren wanted to sell his position in Coke, which is about $20 billion, that would devalue the company just because he's selling it. And if he did sell it and he took out his $20 billion, he'd have to pay capital gains on $19 billion of it. But then where would he put the money? He's already got too much money in cash. And so he elects to keep the cash, keep it where he is, but he's not as nimble as you and I are. I can buy and sell a position in 5 minutes. So there's a unique set of circumstances that every one of you have and that I have and that Warren has, which will color our decisions. So don't look at it and say, I only buy stocks and I want to hold them for 12 months so I can avoid capital gains. If the stock has done great and you got a better option, I think you should consider buying it. So now I'm going to go into this analysis of Coke, which helps you understand why, in the case of Coca-Cola, Warren was a genius, but after 1998, I'm not so sure that he wasn't, or that he was not a genius. He's human like the rest of us. So I want to talk about Coke. I think it's a really good illustration of the both really, really good points about a long-term buy and hold strategy and the really, really bad points, because I think this is an investment which illustrates both exceptionally well. So first, let me give you some background. Warren Buffett bought Coke in 1988. He bought 22,727,273 shares. It's amazing you can get this exact kind of data. He paid on average about $44 a share. And that's about $1 billion that he put into the company. Let's call it exactly $1 billion. The company then has had several events in 1990. By the way, he bought some more, a couple of shares years later, but I'm just going to focus on this because this is when he initially made his big purchase, and most of his holdings is derived from this, okay? So in 1990, the stock split 2 for 1. He had 45 million shares. In 92, it split 2 for 1 again. He had 90 million shares. In 96, it split 2 for 1 again, and he has 181 million shares. In 2012, it splits again, and he has 363 million shares, which is what that investment currently holds. Today, the stock price is about $56 a share. So his $1 billion investment is now worth, call it 20 billion 363 million and a change. So that's a fantastic deal, right? He's got 20 times his investment in 32 years. That's a pretty good return on investment. But it doesn't tell the whole story. I'm going to show you a chart now of what's happened to Coke and its shares over that time frame. So here you can see a chart for Coca-Cola from January 4th of 1998, which was, we know that Warren Buffett bought a bunch of this stock in 1998. We don't know exactly when he bought it. He bought it likely over a period of several quarters. So I'm going to use the whole year of 1998. It's not really relevant what day you start. But January 4th of 1998 was the first day of trading, and he bought shares in the company, let's say at $2.44 a share. Again, that's split adjusted. I already went through all the splits that happened. So he bought it at $2.44 for the sake of conversation. Let's say that's the average price. If he had held that stock for just over 10 and a half years, the stock would have gone up to $42.83, so about 20 times return on his investment. That's what occurred. That's what buying and holding will do, right? He got 20 times his investment. He paid no taxes on that. He paid no commissions. He paid no cost of any kind. And on top of this, he got some dividends. So if you look at this chart, it looks like a genius play to buy and hold, which is, by the way, when a lot of the books that were written on Warren Buffett were written, and they were discussing this sort of thing. But if you buy and hold forever, you don't always go up and to the right. Not every chart goes up and to the right. So here you can see the next slide. This is what happened to the stock between June of 1998 and today. and you can see that the stock went from about 44 down to about 20, so it cut in half, and that the stock stayed down at around 20 for about the next 10 years. So you lost half your money and you lost it and it didn't come back for a long, long time. In about 2009, the stock has started to come back and come back and come back. And by about 2013 or 14, you were back to the peak you were at way back in 1998. So 16 years without a profit. And now the company's trading at $57 a share. So it's gone from about $40 in 1998 to about $57 in today. Ignoring inflation, you know, that's a 40% increase over 22 years. That's not acceptable. That's an absolutely atrocious record. And what happened here is he bought a stock and he refused to sell it. He thought it was a great company and he held it forever. And I'm telling you it was a mistake. And I'm telling you it was an obvious mistake. It's not even close. There's no justification for doing what he did here. And I'll show you why on the next slide. So this slide looks at the PE ratio for Coca-Cola over time. And so if you look at, you can see there's a line there that's 50 times PE. So I don't believe there's any justification for owning a company with a PE much above 30. Anything over 40, I think I would sell in at 50. I mean, I can't wait to sell the thing, okay? So in 1988, when he bought the company, it had about a 25 PE, fine. And then it went up and up and up. And in 1998, it started to approach $40 and $50 a PE of 40 or 50. There's no reason for a long-running, established company whose growth prospects are somewhat limited to expect to be able to justify a 40 times PE. And if you look at this, it continued to go up all the way to 100, almost 100 PE. I think it was about 81 at its peak. So when you think about that, you say to yourself, was there never a time that Warren said, I should sell this? There's got to be better investments out there than a company that's got an 80 times PE ratio. I just don't understand it. I don't think it's justifiable. I wouldn't play along with this. I would be so upset if he had held my money through this period of time. And again, Warren Buffett's the greatest investor of all time. He's going to make mistakes because he's human. But this, I think, was an unforced error and a significant one. I think he should have got out of Coke in 97, 98. Taken that money and invested something else. We're going to talk about what he would have done, what it would have looked like if he had done that in the next slide. So let's talk about if Warren Buffett wasn't committed to Coca-Cola forever. Let's talk about if Warren Buffett had simply said, I'm going to sell this stock when I think it makes sense to sell it. I'll allow you to decide what point you think he should have sold. You don't have to take my word for it, but in 1995, the PE ratio at the end of the year was 30, call it 33. In 96, it was 38. In 97, it was over 40. In 98, the PE ratio was 40, almost 48. In 1999, the PE ratio was 51, almost 52. And in 2000, the PE ratio at the end of the year was 76. So let's assume we can all agree that somewhere between a PE ratio of 30 and a PE ratio of 75 is where 95 or 99% of us would sell the stock. So let's say that he had done that. The next column down is the stock adjusted price for the stock as of the end of the year in 95, 96, 97, etc. The number of shares that he held at that time. So you can see the next column is the price at that point, and that price was split adjusted, so I've had to leave the shares held as if it was the final number, so the split adjustments all works out, but trust me, the math is right. So then you have the value of the stock. So let's look at 1995. In fact, let's look at 1996, because that's probably when I would have argued you have a pretty good case to sell. So in 1996, at the end of the year, the P ratio is 38.2. The price is 26.3, and you own 363 million shares. So that means your stock had a value of $9.5 billion, which means you had a profit of $8.5 billion. That means your your capital gains long-term capital gains at 20% means you would have paid $1.7 billion in capital gains. That would have left you with a net profit of $6.8 billion. Remember, you had your initial billion that you started with, which you weren't paying taxes on, so that means you had the value of your holding in Coke after taxes was $7.83 billion. So let's say you had sold Coke at that point, you paid your taxes, you gave the treasury $1.7 billion, you had $7.8 billion left. Coca-Cola's price today is 56, so the value of Coca-Cola today for those shares would be $20 billion. But if you'd have taken that $7.8 billion, you'd bought it in the S&P in December of 1996, which was trading at $766. Today, the S&P is trading at 33.29, which means that instead of your value of your Coke holdings being $20 billion, almost $21 billion, the value of your Coke holdings would be the value of your new holdings, the S&P 500, would be $34 billion. So what I'm suggesting to you here is that you would have almost twice as much money as Warren has if you'd have recognized that the price of Coke was very, very high and sold it, and then just simply bought the S&P 500. Now we know Warren's going to outperform the S&P 500 over the period of time between 1996 and 2020, and so we know that he would have done even better if he had just gotten rid of Coke. So what I'm trying to say here is, and you can see that the numbers are different for every year depending on when he bought it. Obviously in 1999, he would have done about the same with Coke as he did selling. That's because in 1999, the S&P was so high. I don't think anybody rational value investor would be buying the S&P 500 in 1999. But the point I'm trying to make here is that there is no dogmatic right way to do things, and there is nothing that makes sense in all cases all the time. If Warren Buffett bought Coke in 1988 and held it for 10 years, and that was the absolute right play. But somewhere along the line, it stopped being the right play. Man, it seems pretty obvious when you look at these numbers. So don't simply say buying and holding is the right strategy, in my opinion. The strategy is buy the company when it's a good company, hold it while it's still undervalued, or while it's still reasonably valued. But at some point, Mr. Market might decide it's worth way more than it really is. And at that point, you should take your profits and go find something that Mr. Market places less value on. So hopefully that helps, and hopefully that gives you some perspective on the fact that there's no cut and dried rule to any of this.